Before moving into live trading, you need to know about leverage and margin. Fortunately, all of the calculations are done automatically inside TradingView, so you just need to understand its usage and not necessarily the formulas used to calculate it. By utilizing leverage, we are borrowing money from our broker in order to trade larger positions, allowing us to capitalize on smaller moves in the markets than if we were trading at dollar-for-dollar account values. To ensure you can pay back any potential losses, the broker holds a certain amount of funds as collateral on the loan. This is what we refer to as margin. The margin requirement changes for each currency and varies between brokers. Leverage is shown as a ratio, much like our reward to risk ratio, and it represents the multiple of the required margin we can trade with. When using 50-to-1 leverage, we would need just 1/50th or 2% of the value of the trade to be held as margin. In other words, the trade would be worth 50 times the margin cost of the trade. This field that says trade value I find somewhat confusing. That is actually the margin cost of the trade, and I consider the value of the trade to be this margin cost multiplied by our leverage. In this screenshot, we can see our pair is sitting at 50-to-1 leverage. We are looking to buy 1,000 units of US dollar. So 1,000 divided by 50 equals 20, which is marked as our trade value, or what I consider margin cost. Now, notice that this calculation is only that easy when our native currency is the first pair. What I mean by this is my native account currency is US dollars, and we are looking at the US dollar Canadian dollar. When trading a pair like the New Zealand dollar US dollar, it will actually do this calculation related to New Zealand dollars, then we'll convert it to our native account currency. We never actually need to do this calculation. Instead, just be aware of your margin level and how much of a buffer you have remaining. Just a word of caution. If you have used up all or almost all of your margin and your trades begin to move against you, your broker may reach out with a warning in the form of a margin call. This is where they will call on you to either add more funds to grow your available margin or to close a few of your trades to free up some margin. If you do nothing and your trades continue to move against you, they will be able to close any or all of your trades in order to free up enough margin. Utilizing leverage is extremely useful for traders. However, do be aware that leverage also makes it very easy to lose money very quickly, and without protecting yourself, you could potentially lose more than your entire account balance. You must always trade with a stop loss on every trade to ensure your losses are kept to a comfortable and affordable level.